Hi, everyone. We are here to discuss how to optimize offshore jurisdiction for your fund launch. I hope you will enjoy this webinar. I have a very esteemed panel. They will make an intro, but I will not be moderating this webinar. I have Ron Gaffner who will introduce himself and ask others to make an intro. I will be doing most of the work on the polling and on the screens. Ron, please.
So good morning, good afternoon, good evening, depending on where you're dialing in from or watching this from. The format today is going to be, we're going to introduce ourselves, as Mohammed said. We have some slides that each panelist will discuss their slides briefly. And then we're going to go into Q&A on the panel, and then we're going to open it up to each of you listening so that you can stump the other panelists along with me. My name's Ron Gaffner. I'm a founding partner of the law firm Status and Goldberg. I started my career at the United States Securities and Exchange Commission, where I had prosecuted asset managers. Status and Goldberg represents over 1,000 private funds, which both is hedge, private equity, venture capital, real estate, commodity pool, or for those speaking non-US parlance, open-end and closed-end funds. And our practice is global, but we're located in the United States. Phil, why don't you introduce yourself, and then we're going to go from Phil to Trinda to Mark to Philippa.
Perfect. Thanks very much indeed, Ron. My name's Philip Graham. I'm the Global Head of Investment Funds at Harneys, an offshore law firm based in 9 different offices all over the world, primarily specializing in the BVI, Cayman Islands, and a variety of other jurisdictions. I've now been offshore for 17 years almost, and spent the vast majority of my time in the BVI throughout that period. I've been chair of the BVI Funds Association now for over 10 years, and so very proud to be here today to talk about the BVI.
Hi, everyone. My name is Trinda Blackmore. I am with Orem, based here in the Cayman Islands. Our partners personally act as professional directors on the boards of hedge funds, PE funds, and other structures that might need some independent governance. Personally, I've been working as a director for 10 years. And prior to that, I spent 11 years in fund administration and have an accounting background. So really our approach is to build long-term relationships with our clients and be that voice that they can, or be that ear that they can reach out to when they need something to discuss, a bit of advice, and help them along in their governance journey.
Good evening, good morning, good afternoon, everybody. My name is Mark Cleary. I work for Zedra, which is a global service provider, and I specifically work out of our Jersey and also our Guernsey offices. My role is as the head of our Channel Islands funds proposition, and I've worked in and around fund administration for at least 25 years. So it's a pleasure to be here, and I hope you all take something from this webinar.
Hi, I'm Philippa Lucy Robertson. I work with Mark at Zedra, but for the Cayman Islands team. I've worked in the Cayman funds business for about 15 years now, and primarily on the fund administration side and legal and operations, working with managers from setup right the way through till end of life of their structures. So delighted to be here and look forward to this discussion.
Well, thank you guys so much for your introductions. Phil, we're going to turn to you with regard to the slides to provide an overview.
Thanks, Ron. Very conscious we have the slides in front of them, so not intending to read through them, but obviously they can be shared afterwards. I think sort of in my experience, to keep this relatively short, when people come to us in the BVI, what are they looking for? You know, they are often coming because they've heard it's cost effective. They're often coming because they've heard we can launch pretty quickly. They're often coming because they've heard about our regulatory environment being pretty flexible. The tax neutrality we can come on to later, as with the confidentiality. But what's interesting, I think, is because the BVI fund regime has actually been running since the mid-90s. It's sort of because of the size of the BVI as a registry, there have been over 400,000 active BVI companies. The jurisdiction is synonymous for generally doing international structuring. But I always describe it as a bit of a jack of all trades. It is always trying to pitch itself in a variety of different ways to make sure it can meet all of the different requirements. And the fundamental plumbing, the legislation that's come through, year after year after year, has always tried to make sure it's as flexible as possible. Now, on the investment fund side, that has been absolutely tantamount through the 1996 Act, and then as we came through to sort of the 2010 Act, which updated everything, and then since then we've tried to bring in new products and create new markets for what we felt was important. I think today, given the topic of conversation, what I'd really like to sort of talk about a little bit are some of the products we squarely aimed at emerging managers. We were incredibly conscious that the barrier for entry for emerging managers was just getting higher and higher and higher. I can vividly remember attending an emerging manager conference where someone on a panel with me turned around to everyone, and when they were asked what is an emerging manager to you, and they said it's anyone under $1 billion. And I sort of turned to look at them and just shook my head that it can't be right that that's how we describe emerging managers. That is not what this industry should be. And so we sort of came back and said, look, there must be a way to actually get people started. That classic chicken and egg problem that every new manager has is you want to raise capital, but you need a track record to do it, but you can't get a track record without having capital. And we were desperately trying as a jurisdiction to capture that. So we'll come on to it later, but we created a few products to try and meet that. And actually it's been really successful. So, over 2,000 regulated funds, an awful lot of SPVs in and around that. We have a management product that's very popular as well, and I can come on to that later. But fundamentally, really look forward to talking about the BVI.
So next on the slides, Mohammed, that is your domain. And Phil, are you done with your slide overview? Or you have more you'd like to share?
Yeah, done for my intro on the BVI, but obviously looking forward to answering any questions on it.
I wasn't suggesting you were not allowed to speak after this. Okay. With regard to next on the slides, why don't you continue unless you want to go to a Q&A, Mohammed?
Okay, I think question answer, we can shoot our first questions here to the panelists.
Well, it might be, in retrospect, it may be early if Phil hasn't gone into any of those in detail. But the question is, what is one of the benefits of incorporating a fund in the BVI? I hope it's not high setup and operational costs or a lengthy incorporation process. So
yeah, I'm hoping someone slipped.
I'm not going to give anybody the answer, but I'm going to help share deductive reasoning with you.
I have done a truly terrible introduction if that was the conclusion.
No, that's okay. So we're going to give you about 5 seconds to answer that. And in the event any of you have questions as we were continuing, Mohammed and I will go through the questions being posed and consider them as we're speaking. So the next set of slides we have are what are the advantages of incorporating in the Cayman Islands?
Okay, I can start this. Hi, everybody. So as many of you will be aware, the Cayman Islands highly regarded as one of the premier jurisdictions in the offshore funds industry. Much like Phil was saying for BVI, tax neutrality, there's no direct taxes on income or capital gains or profits. Indeed, the Cayman Islands government have introduced something whereby whereby companies can apply to the Ministry of Finance and have that apply for a certificate to have that enshrined, so that they will not, even if taxes are introduced, they will not have to pay any for the period of time of that certificate. Cayman has a very stable political regime as a British overseas territory. It has a robust and very well-established legal system based on English common law, a very well-established court system and extensive jurisprudence alongside. This helps instill a lot of confidence in institutional investors, knowing that if anything goes sideways at any point, that there is a good system in place for recourse as needed. There are a wealth of service providers on islands. The island is full of lawyers, accountants, and auditors, fund administrators, everybody that's well equipped and very knowledgeable to support your fund through its life cycle and deal with anything that happens along the way. And one of probably the huge pull of the jurisdiction is its robust regulatory regime. Cayman is often regarded as quite burdensome in some ways, but one of the best things about Cayman is that it does strike a really good balance between meeting global standards of investor protection and anti-money laundering alongside innovation, supporting innovation, introducing new, which we can touch on later, but introducing new products, much in the same way as Phil said about BVI. For example, introducing the LLC as a new fund vehicle in 2016, and in 2020, introducing the new VASP regime to support the use of digital assets in Cayman as well. In terms of speed and cost, yes, Cayman can be regarded as quite an expensive jurisdiction, but it is very cost efficient in terms of, efficient in terms of its speed to market. You can incorporate vehicles on the same day, and the process in terms of regulation is far more swift and efficient than other jurisdictions comparatively. And I think, Trinda, do you want to speak more to service providers in the jurisdiction? Okay, Trinda, you're on mute. Sorry.
Someone had to do it. Yes, thank you. So thinking about service providers selection, and I guess this doesn't just apply to the Cayman Islands, but applies to all jurisdictions. And we were talking about this a bit earlier, and it really depends on the different roles that you're looking at and what you look for in those different roles. And I think there's a balance of minimizing the number of providers that you're using while at the same time still having independence where you need it between different providers. So administrators, for example, might be able to wear 2 or 3 hats, but you would want them to be separate from audit and separate from legal or directors, for example. And I think the main thing to keep in mind is that you're just looking to build a team around you that are great long-term partners and can help you efficiently do your job. So if you're looking at administrators, then you have to think about what's important. If it's their reporting that they have or the client service model, does that jive with the client service model that you have in place? Looking at directors or legal counsel, you might want to think best about who do I just get along well with? Who is someone that I feel like I can reach out and have a great conversation, that we see each other as equals and partners in this, and not condescending or anything like that as you're learning the fund management business and how different jurisdictions offer different rules and regulations. I think along those lines, if we just continue, Mohammed, with the slides, some things to think about as well as regards to structuring your fund. And again, this is also not just specific to the Cayman Islands, but really any of the jurisdictions that you're choosing. There's a lot of decisions to be made, and you first say, okay, I'm going to go with this jurisdiction, and then which structure am I going to choose? And I think one thing to think about all throughout your launch is, who is my target investor? Because that drives a lot of your decisions. It's maybe US investors, institutional investors, are they European? And that will help you, I think, in conjunction with your advisors, choose the best structure. If you want the classic master feeder, with a Cayman master and then a Delaware and Cayman feeder, or if you think about, do we need some European offering, then you really have to come back to that idea of what are my investors going to be looking for. The other thing that I think is important, and this is some advice that I give often, is to put the structure in place from the beginning. It can be tempting to go for a cheaper route and say, oh, I'll change that when I get those institutional investors, or I will change that when we get to a certain size. But in the long run, it can end up costing you double because you're effectively doing the documents twice. So that's one thing that I think, if that opportunity is there, is to put it in place from the beginning.
Let me pause you for one quick second just to add something, if it's okay.
Sure.
It's not just about money. It's also about how you have to communicate it to your investors. Two, whether there are changes that would require consent, which once managers go to product to investors, historically they are loath to go back to investors to get their consent.
Yeah,
So
that's a really good
those
point.
would be the
Yeah.
bigger concerns I had in, let me just commoditize something, get it out quickly. And then how do I enter, or it can create regulatory problems that cannot be undone that come with a price.
Yeah,
And I'm not talking about
great
just
points,
legal
Rob.
fees price. Yeah.
Yeah. And I also think too, when you think about structure and service providers and all aspects of it, when you're having conversations with prospective investors and you say, oh, I will put that in place, or versus the conversation to say, yes, we have that, it makes for much easier conversation and makes it easier for them to write you a ticket, which is the end goal, right? I think as far as costs, and this one is a bit more specific, Cayman, when you talk about choosing jurisdictions, I think the biggest black mark that people will give Cayman is the cost. But I think if we change that narrative and remember why those extra regulatory requirements are in place or those extra roles in place, it's really because Cayman looks to be at the forefront of best practices. And a lot of these roles have been put into place because of external demands, whether it's other jurisdictions, the EU, or whether it's regulators, or whether it's the FATF that's saying these are the things that we want to see from your jurisdiction. That's why they're in place in Cayman, and I think that contributes to why Cayman is held in high regard. And unfortunately, with those additional roles and the level of scrutiny comes a bit more cost.
Thank you, Trinda.
Great.
So I think we're on to marking the slides for Jersey. And for those Americans, we're not referring to New Jersey. Oh,
Uh,
by the way,
you missed the
Mohammed,
polling question,
do
Ron,
you
but
want to pose the Q&A first to
Sure,
Cayman?
thank you.
That was
Thank
my
you.
bad. I got too
No,
excited to hear about Jersey.
let me launch.
So the question is, for those of you who cannot read, I will read it to you. Which of the following is the advantage of setting up a fund in the Cayman Islands? Is it the professional services, the robust regulatory framework, or the flexibility structures? Choose one of the following. Choose wisely. Okay. For the last presenter on the slides, we're going to go to Mark Cleary from Zedra.
so good morning again, everybody. I figured when I was writing this, I'd probably have to work a little bit harder than everybody else, knowing that Jersey is probably not in your normal orbit for considering, fund domicile or fund jurisdiction. So I've picked just 4 things to really give you a flavour of Jersey, and I'm very pleased Ron has already done the geography lesson. The Jersey that he is referring to is about 14 miles just off of the north of France, and on a very good day we can see across to it from where we are. That being said, Jersey, why would you possibly even consider it? First up, Jersey's been an international financial services centre for the best part of 60 years. And depending on your perspective on history, for a lot longer than that. We are, extremely well regarded in the fund administration space. We kind of cut our teeth on open-ended structures through the 70s, 80s, and 90s. And from the 90s onward, we focused a lot on close-ended private assets, typical GP, LP structures. So a lot of experience comes with Jersey. Our regulatory environment, we do have a very stringent framework when it comes to fighting financial crime, terrorist financing, proliferation financing, etc. And we think that's the right thing to do. However, we've also got a flexible regulatory framework from the perspective of fund creators. There's lots of choice and optionality for emerging managers setting up, their fund 1, 2, or 3. And there's also different levels of investor protection as well. So there's lots of choice available. The third point really is we all live now in this VUCA world, and stability definitely comes at a premium. We're very fortunate in Jersey in that our jurisdiction has had stability, political stability, economic stability, going back hundreds of years, possibly even longer than that. So any emerging manager, coming to Jersey can be assured of stability. And the final point I've put down there is all about substance. So what that means is, Jersey is not just a PO box. It really is a jurisdiction where, we have something like 17,000 financial services professionals working on island. Some of my fellow panelists have already spoke about the availability of, professional services, administrators. Well, that's exactly the same in Jersey. The other obvious thing, which I haven't listed there, but I'll just mention it, is any emerging manager looking to raise capital into Europe, given where we're geographically positioned. It's a natural vector into Europe to raise capital, especially from the various national private placement regimes that exist. So that's a very high level flavor. I'm looking forward to hearing any questions that Ron or my fellow panelists may have on Jersey. And thank you very much so far.
Thank you very much, Phil, Trinda, Mark, and Philippa. So first question, and it's open to everybody, is for emerging managers, what's the most common question or questions you receive, either tied to your jurisdiction, the structure, commercial practice, or operational? And if
I'll go
nobody wants to
first if you
offer
want.
an answer, I can pick
No,
on you.
I'll take that.
Okay.
We often get questions about, how long does it take to establish a fund, and probably very similar to a lot of the other jurisdictions around on the panel. Jersey can set up funds extremely quickly. I mean, literally within a couple of days. However, that's not the end of the story. Our regulator expects service providers to have undertaken, some real proper due diligence on managers that come to us. So that period where we are getting to know and understand the manager, their strategy, their bona fides, can take anything from 6 to 8 weeks, possibly even longer, and it really boils down to how quickly and how efficiently information is transported from the manager to us, so we can understand it properly. Once we've done all of that element, then legal structures can be established and funds can be launched extremely quickly. That's a very common question at the outset.
I'd echo that from Cayman, and just to supplement that, Ron, I would say that one of the main advantages that when we're in it from the beginning at the setup is really engaging every service provider in those discussions, not just the fund's legal counsel, but also the administrator, the auditors, directors, onshore counsel, so that you get the most holistic view possible of what they're trying to achieve, what their investors are looking for, and then you can actually hope to get the product that they like, and everything really kind of concrete and nailed down from the outset, so that the structure is quite solid from the beginning, and yeah, then there's no hiccups as they go down the road.
And I think if I just jump in here, and I guess staying in my wheelhouse, working as a professional independent director, most often the question I get asked is, what does an independent director do and why do I need one? And I think it might take emerging managers a little while to get their head around that. So I like to explain it, and this is how I explain to my mom when she asks what I do for work, is that inherently in funds there are conflicts of interest, and I really see this as the biggest advantage of adding some independence to a board, is that we're there to help mitigate those conflicts of interest. So if you think of a manager setting up a fund, the manager is conflicted in that they're charging that fund fees. They may have a say in valuation policy. They definitely have a say in trading strategies. And so when you bring in professional directors, then you get that independence that helps ensure there is oversight and you have a third party really looking out for the best interests of the investors. And we've talked a bit about your target investors when you're launching funds and thinking about the life of your fund. Your sophisticated investors and the institutional investors, they have a real understanding of this. And so that's why they're one of the driving factors in making sure that there is independence on that board, just so that there is independent oversight of the service providers, the manager being one of them. I think we definitely get the added benefit too that because independent directors see a variety of funds like your other service providers, they can really help guide in best practices, to say, oh, we have this side letter. What are you seeing others do for this side letter? Different scenarios, and especially when it comes to things like regulation, whichever jurisdiction you are choosing to incorporate your fund, you'd want to choose directors that have a good handle on the regulatory requirements of that jurisdiction and can help you with those reminders to say, oh, how are we meeting this? This is what we need to have in place, and this is when this needs to be done by. So I think selfishly, I can share that that's what I most often get asked about emerging
And does
managers.
your mother clap when you finish with the response, or does she stay silent in awe?
I think she glazes over by the time I get there.
But for what it's worth, how I've described it over the years to people, the role of a director is they neither represent the manager nor the investors. They are there to try and ensure that everybody's complying with the terms of the offering documents, including the third-party vendors. Is the audit done correctly? Is it fair value if it's GAAP? To trying to assess if there's conflicts that need to be disclosed or reviewed by certain parties.
Yeah, great
So,
points.
so Mark and or Phil, I assume you'd like an opportunity to take a crack at that question.
I think Mark has had his go, so I'll quickly jump in. I mean, I think agree with everything that's been said. I'd probably emerging manager calls and the intro ones are always full of a ton of questions. So there's an awful lot we could cover here. I'd probably want to address just here two aspects that I think are always slightly confused. The first one is tax. I think we quite often get sort of approaches from people saying, great, I've gone offshore, I don't need to worry about tax anymore. And that often is combined with, I don't need to worry about local regulations anymore. If I just use an offshore vehicle, I'm sort of away from the physical realities of what I'm doing. That is not true in any sense. And one of the most boring parts of my answer to that question is to say, look, whilst we can give you a very flexible tax neutral structure, there is an awful lot of other things to think about. As we've already rightfully said, where your investors are based is going to become a really important conversation. The taxation system that they will be subject to is going to become a really important conversation. The taxation system, and Ron, you can go into far better depth than me on this, but the taxation system of the underlying assets is going to become very important to the structure you choose. There's a FATCA CRS conversation that no one ever wants to have, but fundamentally we need to get into as well. So there's an awful lot of tax to talk about. There's an awful lot of regulation. You can be based anywhere in the world, and just by choosing to be offshore does not mean that you don't have to worry about where you're physically located. And so we have to get into that. And I think part of Trinda's part of being the director as well is also taking away some of those tax complications that some people have, and we can get into that sort of mind and management concepts. I know Mark does an awful lot in that space as well. The other thing, just on timing, and I think it's a really odd tail wagging dog conversation. But when people talk to us about timing, my immediate riposte is, well, what kind of banking relationships do you already have? Because that is often the answer to when can you actually get launched. We on this screen can all frankly hustle pretty quickly. I think my record of getting a fund launched in the BVI is 10 days from data instruction to actually getting it fully approved. But that was because they had the bank fully lined up already to be able to accept subscriptions within that period of time. If you haven't got that, again, one of the misconceptions is that some people come in thinking you need an offshore bank account to use an offshore structure. You don't. You can use a bank anywhere in the world, but you got to find a bank that's comfortable with banking you. And that can be a bit of a difficult conversation. And if you've never met this bank before and you've got to go through what will be a relatively intense KYC process, that really can add some time to what you're doing. So fundamentally, looking at your banking, looking at your tax, looking at your regulation is all part of the conversations that we'll be having. But we could talk for hours about each one of those. I appreciate.
Sorry, if I may just build on what Phil had just said about the banking relationships, that fully concur with that. And I would say that a lot of the time an interesting thing, I mean, I think with Cayman particularly, there's this kind of misconception from every kind of cult 80s and 90s movie that you can open a Cayman bank account in a day in any name. And I mean, we all know that that's, a huge myth, and it's incredibly hard to get accounts on island. What we have seen is that generally a lot of the banks have their main relationships with the administrator, a fund administrator themselves, knowing that the fund administrator does the due diligence on the underlying investors of the fund. So Zedra Cayman, for example, we have our banking partners, and they generally would work with our, they will, subject to their own kind of risk profile on the funds themselves. That having a regulated fund administrator appointed to your fund actually helps also with the banking relationships. Should you wish to open an account on island, although as Phil said, that's not necessarily a requirement. I'd probably say that's another question that comes up is jurisdiction of where do your service providers generally need to be located from directors, from a substance point of view, and the split of those, for example, between somebody from the manager side and then independent directors like Trinda who sit on the boards of these funds. What split should we have? Do we need a fund administrator? Do they have to be based in Cayman? And same with auditors. So I'd say location is a huge kind of concept as well.
Ron, can I just add a point on the bank accounts?
Certainly.
So traditional banks, depending on where they are in the cycle, will be either willing to open bank accounts or not. Certainly at the moment, most of the traditional banks that we interact with are not that keen to open transactional bank accounts. We've definitely seen a trend of a move to sort of e-money service providers over the last 12 months, which are often back-ended by one of the bigger banks anyway, but getting accounts opened and operational can be done in a much quicker time frame with them.
Oh, thank you very much. By the way, Mohammed, I believe we did not go through the polling question for
Yes.
Jersey.
Yes, thank
I
you.
remember seeing questions about John Bon Jovi there. Question is, which of the following is the strategic benefit of establishing a fund in Jersey? Jersey's reputation for a flexible regulatory environment, reputation for high cost and compliance burdens, or strong regulatory standards and political stability? These are very challenging questions. I'd like to see if anybody is genius and got them all right. So the good news is that concludes the slides. I don't believe we have any ongoing questions yet. And if we did, I assume Mohammed might tell me, but I
Yes,
didn't see any there as
no
well.
one has submitted
So-
the question yet.
So let's talk then about something we're not going to necessarily be able to read about. In each of your jurisdictions, what regulatory trends have you seen occurring over the last few years? So maybe we can plot out where it might be going, right? Because we talked about FAC and CRS, Phil, you mentioned those. So some of them are local regimes and some of them are dealing with other regimes outside the jurisdiction, but that might have an impact on the local regime. there's any information any of you can provide on that subject, that'd be helpful.
I think on the Cayman side, one of the kind of big changes in recent years has been the move to kind of bring most funds within the regulatory regime in Cayman under CIMA, whereas previously many funds were outside of scope prior to 2020, closed-ended funds being the main bulk of that. As well as funds with less than 15 investors with voting rights, and the introduction of the private funds regime in Cayman obviously brought a lot more funds in scope, and on the mutual fund side kind of removed a lot of the exemptions upon which many funds were relying previously. As such, CIMA has a greater reach on the market. There are very limited circumstances, although there's certain non-fund arrangements prescribed by CIMA, which keep certain things such as single investor funds and sovereign funds, single family office structures outside of the regulatory regime. But I would say that regulatory reach has been quite extensive in the last 4 years to alter the market slightly.
Yeah, but I mean, even from a regulatory perspective, one of the things we saw probably a little over 2 years ago was the sanctions against Russia, and then how we had to deal with other jurisdictions with regard to how to segregate assets that should have been frozen from the assets that were not necessarily needed to be frozen. I know that at times from jurisdiction to jurisdiction, different firms and organizations had different approaches to it.
I think everybody struggled with that. Is my view, to be honest. I don't know if there was many global regulators that were very clear in terms of their instructions in what needed to be done. But in terms of like just more general regulatory trends, in Jersey, a broad trend that we've seen is a move away from funds being authorized by sort of a central regulator to that actual process being delegated to a manager who is itself a regulated entity. So in some ways that is a regulatory institution sort of outsourcing the approval process, and at the very and all they actually do at the end is sort of review from a sort of a light perspective, an application and approval of a scheme. In Jersey, we also had the private fund rules introduced about 4 or 5 years ago. There was a big sort of trend a number of years ago for regulatory sandboxes for more innovative products, particularly in the digital asset space, when nobody really knew or understood, what they were. Jersey certainly went down that route, and I can go into, what they've more recently done in that regard as well.
I mean, to that end, Phil, I know that you and I at times have worked on a lot of digital asset related funds, crypto funds, our firm. Have you found that one jurisdiction was better for that strategy versus any other jurisdiction?
I think the really, I mean, we as you know, like with you, Ron, we absolutely love the crypto space, and I think what we found, we launched our first crypto fund in 2015. We've launched, I think, over 300 now, all shapes and sizes. And what's really interesting is the type of client that comes through there is not the type of client you would get necessarily in TradFi. And I think one of the things that come with it, without wanting to sort of bash my Cayman panelists, is that there is a classic sort of, when you're looking at traditional fund structures, because Cayman is so unbelievably popular and has done so unbelievably well on the fund side, that there's almost a, I'm going to say lazy, and it's not the fair word, but it's almost a lazy choice to choose Cayman because it's such a well-trodden path. And sort of one of the classic things any emerging manager wants to think about is, if it ain't broke, don't fix it. If everyone else has done a Cayman fund, why on earth would you choose not to do that? Because when you're going through your DDQ and an investor turns around and says, well, why aren't you a Cayman fund? I've only invested in the last 10 have been Cayman funds. You've got to answer that question, and minimizing your DDQ down from 10 pages to 9 is always somewhat in everyone's best interest. But actually on the crypto fund side, you're not getting traditional fund managers who are looking at other fund managers and saying, what have they done? You've actually got people who are asking sort of more basic questions as to, why do I need this fund structure? What does it do? What does it do in terms of the counterparties you're facing, whether that's centralized exchanges, whether that's DEXs, whatever it might be? And how do you interact with everything else I am? I'm a digital nomad. I spend 2 months of my life in 5 different continents, constantly moving around. Where do I need this to be? And we found on the BVI side that they were really attracted by the flexibility of the BVI. And so I'd say, on a more traditional side, Cayman is still the dominant player in almost every continent we operate in. On the crypto side, no matter which continent you're in, actually BVI is a really interesting conversation. And again, when you look at the fund manager product, which has some sort of benefits over the sort of equivalent Cayman one, certainly in relation to economic substance, which we've mentioned already on here, then that tying up with that has meant that BVI certainly proved to be a pretty popular crypto choice. But you ultimately need to find a regulator, and all three of us here can say it very confidently. You need to find a regulator who's very confident and understands this space as well. And I think you've got 3 regulators in these jurisdictions who, A, do get it. They have experts who have been looking at this for a while, and B, want to embrace it, accept that this is a thing, this isn't going away, it's not a fad, and really want to bring in the right clients in the right way so that these jurisdictions can actually be at the forefront of a lot of what is going on at the moment.
So I want to go to Mark on this question, and I'm not trying to put you on the defensive, but you probably hear this commentary in the past. So given the popularity of Cayman and BVI, who outside of managers domiciled in the UK, what tends to drive non-UK managers or offshore managers from a Brit's perspective into using Jersey?
Yeah, that is a fairly tough question.
Well, that's why I had to ask you. I got to see if I can
Yeah,
make you
no,
sweat.
I do think our proximity to Europe is a key advantage for Jersey. And I mentioned it briefly in my introduction. If there's any managers in the US that are looking to raise capital in Europe, particularly only in a small number of jurisdictions, then Jersey is really a vector that you should be thinking about, or at least considering alongside Cayman and or the BVI. That's really what our, or one of our playbooks is, to appeal to US managers. I mean, over and
And
above that, all of the points that I previously mentioned, you know, and very briefly, in some thumbnails, we have experience launching and managing and administering collective investment schemes in all forms for over 60 years. You will also see a lot of familiarity, and I think that term is very important. You want to go to a jurisdiction where you feel like you understand, the terminology that's used, the language that's used, the laws that are in place. And one of the things, just to give an example, I know Philip has already mentioned the LLC regime in Cayman. Jersey also introduced an LLC regime modelled off of Delaware and Cayman about 4 years ago. So you will have that element of familiarity as well with the products that we have available in Jersey.
and thank you, Mark. Trinda, what advice do you give new managers when you're having your initial conversation with them?
I think we touched on some of this already in thinking about how important your target investor is. And how much of that drives jurisdiction, drives structure, drives service providers.
Sure. So I was
And
hoping maybe you'd elaborate because I know you touched on it.
yeah,
So if you want to
so
go a little vertical there, that'd be great.
great. So I think that if you picture yourself in those conversations a year down the road, 2 years down the road, you want to be able to give them thoughtful answers and the answers that they're going to want to hear. So, they're going to want to hear that you're choosing, that you have an independent administrator, that you have an auditor that can meet the requirements of the investor's needs. They're going to want to hear that you're using, you know, best of breed technology with the admins. And I think that it can just make some of those conversations a lot easier if you've thought about how you're going to structure that. What else had I said? We talked already about how it can be easier to put that structure in place from the beginning, both from a financial side, from the point of not having to redo documents, from the point of not having to go out to your existing investors. So if you can get that structure in place from the start, then it really helps you think about saving yourself time and money down the road. I think another thing that's important for new managers is potentially outsourcing some of their management roles. So maybe they want to outsource the back office accounting that a manager may do. They want to outsource some of the compliance functions. And then that allows them to focus on what they're best at, which is managing. And then they can lean on other service providers that may not be the traditional fund service providers to help them meet their role as an investment manager. I think that covers what I was thinking about.
Sounds good. And by the way, I open that up to anybody else on the panel as well with managers. I'll give you my own quick response to that end. So when Trinda was mentioning who your investors are, it's, are they high net worth? Are they family offices? Are they institutional investors? Usually emerging managers on average do not know unless it's somebody with a very strong pedigree. And then they tend to attract more often institutional with a smattering of high net worth. It is not uncommon to set up a fund structure for high net worths and then add on to the products other funds that are more favorably structured for institutional investors with terms they expect. We also look to the service providers they engage. And I say this because while it sounds like common sense, somebody might hire a lawyer to launch a fund. I received a phone call from somebody with a regulatory defense issue who supposedly had their documents done by their administrator. So, and we all act as a check and balance for one another. Many of us know each other's firms, whether we may know each other directly. There's a familiarity, which is a sense of safety for a manager who's engaging a vendor to know that they're in the business. And it's not just the institution, because it's hard to tell if you're speaking to an organization with hundreds of people, whether they have sufficient expertise or skill sets. So that will often come through word of mouth, people that have worked with them alongside. And then with regard to jurisdictional choice, interestingly, this didn't get mentioned, but it weighs in when we guide people. The firms you pick and the jurisdictions you pick, you only know it when you're in trouble, whether you picked right. Meaning, when there's an inflection point in the market, such as 2008, and people were having to work out, we're hitting an inflection point now, or have hit an inflection point with asset-backed lending and other alternative finance, where not everything turned out the way and as rosy as the managers suggested they would. So you only know that when you're working through these issues with your vendors, or you know what options you have available in the jurisdiction that you're in. And I don't want to elaborate more because I want to open this up if anybody else wants to share.
One thing I would say is when you're in the process of selecting service providers, if you can afford it, it would really benefit you to actually get on a plane, whether that's to BVI, Cayman or Jersey, and go and experience the jurisdiction and meet the people, and look at the whites of their eyes that you're potentially going to be dealing with, because you can pick up things that you're just not going to be able to pick up over email or Teams calls. So that's 100% a worthwhile investment that you'll make right at the outset. That would be probably my number one recommendation.
Now, while it's a great recommendation, what's interesting is ever since COVID, even people who are local, so I physically sit in New York City. Somebody could be sitting 20 blocks away and it's a 10 or 15-minute walk or cab ride. Zoom, Zoom, Teams, any of these video conferencing has replaced, I would say, 80% of in-person meetings for those sitting in the States. Obviously, if you're sitting in BVI or Jersey or any other jurisdiction, that's harder to go and visit. Let me ask another question I get asked to the panel. So managers are, when they're organizing a jurisdiction, they're like, you know, it's really good. I'm looking forward to the board meetings when I get to go there. And so they're imagining themselves going to a board meeting and sitting on the beach afterwards, I imagine. So for Phil and others on the panel, can you elaborate on there is no need for physical presence if you're involved in that regard? And what you might recommend as commercial best practice?
That is about a 3-hour answer, which I absolutely appreciate. We don't have, and Trinder and we'll have a sort of strong view on that. But you're absolutely right, Ron. That is a very common comment we get as well. And I think one of the aspects of the BVI that we often talk about is actually the lack of sort of local requirements. That there is a core intention in the BVI regulatory regime to absolutely meet the international standards. You have 3 jurisdictions here who have all firmly committed to make sure that they are meeting international standards as far as possible, but also try and retain that flexibility so that people all over the world can have that comfort. I understand entirely what Mark is saying. I think you have the slight advantage in Jersey of being somewhat more accessible. We as a sort of small group of islands in the mid-Atlantic have less opportunity to sort of have people come and visit our shores. So absolutely, kind of Zoom and Teams is very important. Some of that local nexus requirement, though, will come down to what you're actually trying to do. And if you're trying to operate an offshore fund manager and you're trying to actively demonstrate that you're not in fact running your fund from wherever you might be physically located, but you're actually running a fund truly offshore, whether that's one out of one of our jurisdictions or another, then absolutely you need to consider where you're doing meetings. You need to consider, much more than doing an annual board meeting and that's it. Your directors, and someone like Trinder, has a significant amount of expertise here. Your directors need to be actually core and part of your decision making. Now, for a lot of emerging managers, that gets pretty uncomfortable when you begin to talk to them about discretionary investment management decisions, and how they make them and when they make them, and how does that fit in with their strategy? How does that fit in with their underlying assets? How are they trading? How algorithmic is it, et cetera, et cetera? Where are your servers based? All of these kind of conversations get quite intricate. And you're absolutely right, Ron. This is a long conversation with clients as to, here is the legal answer. And I think all of us on this call, and Ron, I know you're very, very good at this. Here is the legal answer, and that's slightly boring. But let's actually have a practical and commercial conversation about how you're going to operate this fund and how you're going to grow, and how you're going to find investors, and how you're going to trade. And that sort of sets your service providers apart. It shouldn't just be a service provider you fit that sort of says, here is your one size fits all, there you go, take it, and it's the lowest possible price you can possibly pay. It should actually be someone who's really going to dig into what you're doing and use the benefit of their experience to talk you through it.
Phil, you just reminded me of something. Our business is not based on fact patterns that are static. Everybody who's listening to this, your lives are dynamic. Our clients, their trading patterns, their portfolio construction is dynamic. So assessing whether your structure and your jurisdiction is correct isn't just occurring on the day of launch, which goes to what you had just said, Phil, about the one-stop shop. Quite frankly, the only time you should pick it is if you don't want to wait and you will never be able to afford a service provider that can provide you a little bit more of an offering. So what do I mean by that? We've had clients trade securities in the United States and other markets, and then all of a sudden, years later, you find out they're trading them in South America using a traditional master feeder structure where the offshore is all domiciled, Cayman, BVI, Bermuda, whatever the jurisdiction. But the reality is there's a double tax treaty that had those trades occurred through a US domiciled entity on behalf of US and non-US persons, there would have been a tax savings. So we, when at the setup, cannot presume to know everything you may do and with whom you are doing it. So like your doctor and hopefully your accountant and hopefully your dentist, you check in, I don't know, more than once every 5 or 6 years. Otherwise, you're dying with horrible teeth in your mouth and owing a lot of taxes.
I
We
think that
all,
leads into it's all about partnership, isn't it? And outset, having that kind of individualized boutique approach to each of your clients, and to really having service providers that are approachable, responsive, and that you can really have that support in place whereby you're not waiting till a problem arises to address it with your service providers, but your service providers are keeping you abreast of changes in regulation, changes in market trends, and trying to kind of really get on the front foot with these kind of things. And I think that's probably the key across everything from your legal advisors, auditors, administrators, certainly your independent directors from Trinda's perspective. It's really having that extra level of care and relationship that's key in all of this.
one of the other trends I've started to see the last 5 or 6 months is we've received correspondence or inbound from managers sort of questioning the guidance they've received to date. And I've seen, we'll use the word tourists. We've seen a lot of managers engage tourists as their vendors in this industry. And the problem is they're giving structuring guidance without any concern or awareness or knowledge of the tax effect. And I've seen involving both BVI and Cayman. So it's not the fault of the jurisdiction. It's the fault of US counsel, because that's not offshore counsel's job to know US tax laws. So when you're thinking about vendors within jurisdictions, yes, you can always switch, but it's harder to switch. And if you switch, wherever you are going, they may not accept the product that was drafted because it's inferior or contains many problems that would make it overly burdensome to fix from an economic perspective or a consent requirement perspective. And then if they touch it, they bear liability. It's the same way if you went to a surgeon, and unfortunately I learned this the hard way through a family member. Any other surgeon is hesitant to touch the work of another surgeon. It's not that far off within legal, within accounting as well. So we're coming up on the hour. Why don't we go around the horn, so to speak, and give each of you 2 or 3 closing sentences to the degree you'd like to leave the audience with any lasting memories. Phil, we're going to be gentlemen here since you're coming up on my screen first. We're going to go ladies first. Philippa, Trinda, Mark, and then Phil, which is like a cleanup batter in baseball in the US. So that's pretty good, Phil.
I don't mind kicking it off. So I guess I would say that on top of choosing a jurisdiction, to really take your time about choosing your fund structure and choosing your service providers, and talk with people that you trust. So people that have launched other funds already, maybe using consultants in the process, because that can be really helpful to say, oh, these people are easy to work with and will get you where you need to be and provide sound advice. So I think it's key to not rush into some of those things and to really lean on your network, and rather than recreate the wheel.
Thank you very much, Trinda.
Yep, I would echo that. I think key takeaway really, relationships and the importance of them. Yeah, making sure that you're leverage all your contacts and your networks, that you're not looking for a kind of off-the-shelf product, which often new managers think is the norm, that one size fits all approach, and just that you can buy an off-the-shelf product. It really should be tweaked and constructed and from the outset to the requirements of the manager, the investors, and taking into account all the different perspectives and inputs and expertise that all the different professional advisors would bring to the table, because everyone comes at it from a very different angle, and that discussions in the early stages are helpful and extremely important. So that would be my kind of key points.
Thank you. Mark?
Very, very similarly, I would say launching a fund, first fund, second fund, is a bit of a journey. Often you don't know the terrain that you're walking across. So I guess I would absolutely emphasize taking advice at every stage. Find yourself good US onshore counsel, link up with good offshore counsel, visit if it's all possible. I think you need to realize that your fund one or fund two will probably have a life anywhere from 5 years to 7 to 8 years. So it's quite an investment, and it's worthwhile getting it right up front. I wish you all luck in your journey launching your funds. Just very briefly, I will be in the States in October. If anybody would like to meet, I'll be in San Francisco, Miami, Palo Alto, Los Angeles. You'll find me on LinkedIn, Mark Cleary, Zedra, and I'll be very happy to meet in person. Thank you for listening.
And Phil, last but not least.
I agree with everything that's been said. I mean, I would say, and it's a slightly depressing point to note, but I love the optimism that emerging managers come with. It's fantastic to hear these brilliant ideas. We've talked a little bit about structuring for sort of institutional investors and all kind of other things. The reality is that probably isn't going to happen for you. And so actually adding into that optimism a degree of realism, structuring something that's sensible, that, as everyone has said, is a great foundation for building something very exciting, but being realistic about what those first few years are going to be. And that's graft. And that is doing as much as you can, trading as well as you can, building that track record as best you can with the limited resources you're going to have available to you, bootstrapping as much as you can, but ultimately getting to where you need to be, and relying on some great people, all of whom are on this call, relying on some great people to really guide you on the way.
Thank you very much. I want to thank our panelists. I want to thank Mohammed. You did a great job anchoring it and keeping me in line. And I want to thank each of you for dialing in and for listening. And we hope to speak to and or see you again soon.
Thank you, everyone.